So the CPI just released the latest US inflation numbers, and I'll just go ahead and tell you right now, they show that inflation is up 9.1% over the past year and up 1.3% just in the month of June. This is even higher than most experts were estimating, and it's going to have potentially worldwide economic impacts through two main mechanisms. Number one, the Fed is watching inflation rates to decide whether or not they should continue to increase interest rates in the economy. And number two, that is going to affect stock markets as they react to these rising interest rates. And then kind of number three, this could also impact whether or not we see a global worldwide recession. So hey everyone, welcome to FinTech, and let's start with number one. What is the Fed going to do based on these rising inflation numbers? Well, historically, the Fed has tried to keep the US at an inflation rate around 2% per year. According to this article from the Pew Research Center, between the start of 1991 and the end of 2019, year-over-year inflation averaged around 2.3% a month and exceeded 5% only 4 times. And if we look at a US chart of inflation over the past 40 years, we can see that since the 1980s, inflation has stayed at a relatively constant rate around 2% per year up until very, very recently. And the Fed wants us to go back to those 2% inflation numbers that we had been seeing in the past. And so in order to do this, they try to raise interest rates in the economy. You can almost think of it like the economy is either hot or cold. When the economy is white hot, maybe because there's a ton of stimulus money being pushed into the economy, or because businesses are starting to open back up after the supply chain issues of COVID are being resolved. That causes the economy to get white hot and inflation can take off, which is a problem because it can erode people's spending power. On the other side of the equation, you have a very cold economy, which would be a recession. Now, the Federal Reserve wants to move us away from this white hot economy with inflation by raising interest rates, basically making it harder to borrow money. This will cool down the economy somewhat, but they don't want to cool it down so much that we fall into a recession. So there's this balancing act between lowering inflation without lowering it too much too quickly. And because of this, the Fed is taking their cues on whether or not to raise interest rates based on what the latest inflation numbers are actually showing. So what are those numbers showing? Well, if we look at the CPI, or Consumer Price Index, released by the US Bureau of Labor Statistics, we can see that over the past 12 months, inflation rose 9.1%. And just over the past month, inflation rose 1.3% in the month of June. Now, this is broken down into a few different categories, but we can see that the areas of food and especially energy are what are driving the majority of the inflation that we're currently seeing. And even though we are seeing much higher inflation than experts were expecting, if we look at the core inflation numbers, they're not quite as extreme. So most economists polled by Reuters expected that the CPI would be up 8.8% year over year, and we beat that by 0.3% overall. That being said, the core CPI was expected to only be up 5.7% year over year. And if we go to the CPI, we can see that that core CPI was actually up 5.9%, which leads us to the second impact that inflation could have on the economy, which is stock prices. In general, stock prices love low interest rates because low interest rates means cheap money can be loaned out to businesses, which lets them grow much faster. This means most companies, especially companies with high growth, do not want to see the Fed start to raise interest rates because that will hurt stock prices. At the same time, long-term investors don't want to see the economy fall apart from inflation that is completely taking off. So again, it's a bit of a balancing act. But we do know that if the Fed decides to raise rates again, it's going to cause a temporary dip in the stock market like it has pretty much every time before. And if we look at the month of June, the Fed did announce a Fed rate increase due to inflation fears of 0.75%. And certain Fed officials are planning another big interest rate increase in July depending on what these latest inflation numbers show. And clearly they're showing that inflation is even higher than expected. Fed Governor Christopher Waller said that he was in support of another 75 basis point hike in July and probably 50 in September. Just the 75 basis point increase hike in June is already the biggest move by the Fed since 1994. And if the Fed continues to increase its Fed rates to the range of 3.25 to 3.5 by the end of 2022, this is increasing from a rate of around 0.5% during COVID to 3.5% by the end of the year. So a 7 times increase in just 1 year. And this has led some big investors to worry that the Fed might be moving too quickly. Cathie Wood personally thinks that we are not going to continue seeing inflation and that we will instead see deflation as supply chains clear up and companies have to deal with an oversupply of goods that they ordered. Both Walmart and Target, for example, currently have too much inventory, and so they're actually cutting prices to try to clear out some of that inventory. And Cathie Wood says that these deflationary forces could put pressure on the Fed to make a policy reversal once they start showing up in the numbers. So even though inflation looks like it's going up right now, it's a lagging indicator. And once the numbers catch up with what's actually happening in the economy today, the Fed is going to have to quickly reverse rate and actually start lowering interest rates instead. And Cathie Wood points to numbers in the gold market, the dollar, and yields that point toward deflationary forces. For example, the fact that gold, which is an inflation hedge, has fallen below $1,700 an ounce, which is down around 12%. And the fact that the 10-year Treasury yield is still below 3%. So it seems to indicate that the bond market does not believe inflation is going to continue. Similarly, other big investors like Michael Burry of The Big Short, who famously predicted the housing crash of 2008, as well as Cathie Wood and Paul Krugman, aren't super worried about inflation, seeing as they also agree that prices are going to start rising more slowly later this year and view even possible deflation in the future. Now, if we do see deflation and the Fed doesn't respond, if we go back to that hot and cold analogy, the Fed may think that the economy is white hot when in reality it's already a little bit cold. And then they're going to try to cool it down even further, which could push us over the edge and into a total global recession, which obviously would not be a good thing. But when it all comes down to it, it may not really come down to the numbers at all. According to a survey by the University of Michigan, consumer sentiment is currently the lowest reading it has ever had on record, at 14.4% below where it sat just in May. Consumers across income, age, education, geographic region, political affiliation, 79% of consumers expect bad times in the year ahead for business conditions, which is the highest we've seen since 2009, when the stock market had already crashed and we were in the Great Recession. Additionally, 47% of consumers blamed inflation for eroding their living standards, which is just 1 point away from the all-time high that we saw during the Great Recession. And US President Joe Biden has named combating inflation and rising costs as his top domestic priority back in May. And at the end of May, Joe Biden also released this Wall Street Journal opinion article titled "My Plan for Fighting Inflation." So clearly the public does not believe that inflation is going away, or they're at least scared enough of inflation that they want somebody to do something about it, which could pressure politicians and then indirectly the Fed to do something regardless of whether or not we're actually going to see inflation. Now, Joe Biden has said, quote, "I won't meddle with the Fed, but I will tackle high prices while guiding the economy's transition to stable and steady growth." So we'll see in the long term if Joe Biden ends up putting any pressure on Fed Chairman Jerome Powell to start raising interest rates even more aggressively or not. But at this point, based on these higher inflation numbers beating out forecasts, I would expect to see another rate increase in July and probably another increase in September after that, which is not good news for the stock market in the short term. But if you're a buy and hold investor who invests over a 5 to 10 year time horizon, and if you dollar cost average into a broad market index fund, which is shown to be the most high performing investment strategy over a long time period, you don't really have to worry about these short-term moves in the market. And even though the stock market is probably going to be down following this announcement, if you sign up for Public using the link in the description, you can get up to $70 worth of free stock simply for signing up, which is one way to get some green into your portfolio on a red day. Don't forget to like and subscribe, and I'll see you next time.